is Moss from Investor Partner Group coming in live today in relation to how to pick. If you want to buy something and it's not a forever home, then do not. This is a topic that resonates with a lot of people. There is people who would have made a lot of mistakes on their property portfolio, and so we'd be talking about what sort of mistakes people make, what does an ideal portfolio looks like, how do you build an ideal property portfolio. If you look at certain scenarios, how much deposit do you have, how much salary do you have, and what should you be buying right now in a market like today. Finally, the original question in relation to how do you identify the mistakes in the portfolio and how do you fix them. For those who don't know me, I am the founder and the director of Investor Partner Group. If you're tuning in for the first time, if you're listening in for the first time, understand that I do a lot of property strategies. I'm a property mentor, a property coach. My portfolio is an active property portfolio. We do a lot of property developments. We also have tax SMSF advisory. So if you have any specific questions in relation to your own personal portfolio, please do reach out to me after the live or drop it in the comments below and ask the questions. Let's kick off how to fix investment portfolio mistakes. And we are going to use contemporary, non-conventional investing methods in understanding some of these. Okay. And so when we are talking about typical portfolio mistakes, there are typically 4 or 5 mistakes that you see investors make all the time. And so one of the first ones that the investor would usually make is buying a fundamentally wrong property. And so you're talking about a property which is a non-investment grade property in a suburb or in a town which is not an investment grade town. And so a lot of people tend to, for example, buy off the plan properties or house and land, packages or apartments or properties in mining towns or flood zone properties. And so it's important to understand that if you're going to buy a fundamentally wrong property, that would be a typical portfolio mistake. And so you need to ensure that you're fixing that mistake. The longer you hold on to some of these properties, the more painful it's going to get as you move along. Okay. The second portfolio mistake that a lot of people tend to make is the wrong timing. And so the timing is of 2 types. There is timing in relation to your own property strategy, and there is a timing in relation to the suburb timing. And I'll go into a bit of detail into both of them. And so when I talk about the timing in relation to your own property portfolio strategy that you're following, a lot of people tend to make that mistake quite religiously, where they would buy a property purely for growth, where they should be balancing growth and cash flow and adding more buffers to the portfolio. Or I've seen people chasing development potential properties where they don't even have the capability or the capacity to do developments. And so why buy a development property in the first place when you are not ready to do a development? Okay. Having said that, when you're building a sustainable property portfolio, you should always be focused on buying the type of properties that have multiple exit strategies. And we'll talk about that as well as we go through this presentation or this live webinar. Some of the key wrong timing decisions in the life also relates to adding excess cash flow into the property portfolio. And so I'm a big believer of, it's not one size fit all. It's making sure that you're creating a portfolio that's not sacrificing your lifestyle or impacting your lifestyle, but it's also quite sustainable in nature. It can take you through market downturns. It can take you through macro environments. It can take you through high interest rate rises. And so you shouldn't be losing your sleep over something like this when you are buying properties. And so you need to think about this upfront and be a much more proactive investor rather than reacting to some of these things. I was talking to a client last week where we spoke probably 9-10 months ago when they were not our clients. And when I was assessing their portfolio, I realized that they've made a mistake on acquiring a property which is great for growth, but the cash flow is something that's going to create a lot of pain for them. Okay. And so great property portfolio. And so I was doing a strategy session with them earlier yesterday. And look, if you know who I'm talking about, please drop it in the comments and say hi to me. Great property portfolio. They've caught close to about $600,000-$700,000 worth of growth, but it's costing them their lifestyle. It's really, really painful. And the only reason is that, they forgot to add cash flow. They were so focused on catching growth that they haven't been catching cash flow. And so now you look at their portfolio, they're really paper rich, but they're cash poor. And so now they're bleeding money. And so one of the comments that they made was that, hey, Moss, but don't forget, I got $40,000 in tax return from the tax office. And I said, wow, that's a great strategy, because you paid $90,000 out of pocket to get $40,000 back. How is that a good investment decision? How about you pay me 90,000, I'll give you 40,000 back? That just doesn't make sense, right? And so it's important to understand that, depreciation and all of that is great, but it's important that the property portfolio is sustainable on its own. And we'll talk about what an ideal property portfolio looks like. The second timing is in relation to the growth of the suburb itself. And so when you're talking about infill suburbs, when you're talking about suburbs which has a lot of developable land, or suburbs which has a lot of developable supply coming through in relation to new housing, you would see that although there might be immense amount of demand, that demand does not translate into price growth or rent growth, and does not create equity or equity growth for yourself. And so getting the timing right for the growth is quite important as well. It's not just about time in the market, it's also about timing the market as well. Okay. And so I'll share a very quick story here too. I was speaking to a real estate agent yesterday who's a client of ours now, and he was talking about this particular suburb in Melbourne called Point Cook, and he bought something there in 2006 for $320,000. And he said, Moss, I don't think that I've seen a lot of growth, because I bought in this suburb in 2006 for 320. This property is now worth probably about 850 to 900. And so yes, it's gone doubled in price, but it's taken 16, 17 years. Imagine if I would have bought something in Ringwood, it would be worth 1.2, 1.3, $1.5 million. And so amazing point, right? So his thinking at that time in 2006 was he bought a house and land package from a sales agent trying to catch depreciation benefits, whereas he could have bought the same property in 2012, 2013, and he would have got the same amount of growth, with no change in price between the two. The fourth typical mistake that a lot of people make is buying the wrong asset type. Okay. And so we've talked about this in relation to the wrong property type, but also the asset type. So this is more in relation to people aiming for full-scale development sites when, again, they don't have the capacity to develop, or it does not fit in their strategy right now. And so you don't need to buy a wrong asset type just because you can. Okay. It's important to understand that as a part of a sustainable property portfolio strategy, you need to ensure what assets to buy at what time. And the last but not the least is about the property size or the land size. And so understand that just this, and I say this quite often, that the size of the diamond ring does not guarantee the success of the marriage. And so the size of the land or the distance from the city does not guarantee the future growth of the property. Okay. There's a lot of factors that comes together when you are talking about growth. Just because the land is 600 square meter does not mean that it's going to deliver the growth to you. It could be that, whole of the suburb has an average size of, 600 square meter. And so what you need to understand, especially when you're talking about particular size of the property, is that you're looking for land to asset to value, which is very, very important. You need to understand you're buying your property as close to the land asset value as possible. The higher price you pay for the property, which is away from the land to asset value, the less growth that you're going to see in some of these properties. I'll give you a very quick example again. So if you think about house and land packages, you buy a property or you buy a land for say 300,000, you put a house on it for say 300,000, and the property is valued at 600,000. The land to asset ratio for these type of properties is about 50. Okay. Whereas if you buy a property where the land value is say, 600,000, and the property cost is only 150 or 200, and the value of the property still say 600, 650, your land to asset valuation would sit somewhere around 70 to 75. So you should always be focused on the land size more in relation to the land to value ratio. Okay. So it's very, very key and very important. A lot of people tend to make that mistake where they would buy bigger size of the property or smaller sizes of the property without realizing what the true value of the land is. And so we've talked about, some of the portfolio mistakes in general, but let's talk about what does an ideal property portfolio looks like and how do you build this. And so when you're talking about a sustainable property portfolio is something that works on its own. It's transferable. It creates intergenerational wealth. It can service itself, and it's well managed. And so, well managed is an important point that I make. That anything that is not well managed, you would lose it. And so you mismanage your marriage, you're looking at a divorce. You mismanage a company, you're looking at bankruptcy. You mismanage a portfolio, and you're looking at a poor retirement, or a portfolio that destroys you completely. So a sustainable property portfolio, in its truest sense, is something that is generating its own income. It's able to pay off its own debt, generates growth over multiple years. So you're not looking at a short-term window of growth. And it's set up in such a way that you can absorb market shocks, higher interest rates, higher inflation, loss of job, etc. All of that, a sustainable property portfolio should be able to absorb it. And the most important, last but not the least, it does not require a real person to provide cash flow or serviceability to it. And so with a sustainable property portfolio, if you've done it right, you don't need to work for that portfolio. That portfolio generates its own serviceability. Okay. And so the banks love these property portfolios as sustainable property portfolios because they would lend you more against it. They will see the portfolio on its own and it's in itself and lend money against them. And so it does not happen automatically. It's quite strategic in nature. You need to understand that it's a process that you need to follow. A lot of the times, if I take a step back and help you understand that, investment property for a lot of people, they treat it like an event, like they're going to get married in the future. And so um, when you're talking about building a property portfolio, it's a process. It shouldn't happen by surprise. It's not that you're going down the road and you buy a property here, buy a property there. It's a method that you need to follow. It's a right order that you need to follow. You need to do the right location selection. You need to do the right property selection. And so a lot of this comes in a much more waterfall approach where you're doing one after another. Okay. And so eventually the property that you're going to buy would be a result or the consequence of you asking the right questions, you making a series of decisions, and naturally you being comfortable in making sure that the decisions that you're making are evidence-based and not just because of what the market is saying or the market is responding. One of the questions that was asked to me yesterday in one of my personal settings or personal mentoring session was, once you can hear media talking about the market is going to crash, the market is going to collapse. And I said to them, over the last 15 years since I've been investing, uh, I've always done what the market has told me not to do. Okay. And so clearly, going against the market has some sort of perils or benefits to it, because what you're doing is you are going against the herd, but you're doing it in a much more risk averse manner, that you are putting evidence based investing behind this. Okay. And so it's very, very important. And so if you find it difficult to do it on your own because you're too emotionally involved or you can't see your situations objectively, go seek help. There's nothing wrong with that, right? And so in the earlier stages of my life, when we were acquiring commercial properties, I'll go out and seek help. There's nothing wrong with that. I don't know how to do land subdivisions, for example. I don't know how to do high rises. And so if I choose to go down that direction, I'll hire those experts to help me understand how some of these things work. Now, everyone should be thinking from that perspective. Hire the right person to do the right job. And if you have time and if you think that you can learn and do it yourself 100%, that should be your notion. Go ahead and do it yourself. Okay. And so the next question naturally becomes, how do you build your portfolio right? Okay. And so there are three key ingredients to building a property portfolio. I call it the Igor formula. And so the three key ingredients are yield, growth, and return. And so this is part of my book as well. And I talk a lot about this in the book. I'm just going to give a really sort of high level view on how to use these three key ingredients. Okay. And so what we are talking about here is yield, which is the annualized return that you're going to get on the property. Growth, which is the equity growth that you're going to get on the property. waiting for the market to deliver that growth to you. And return is the return on investment, or the return on capital, or the return predominantly on the properties through manufactured equity, through you forcing the equity on the property. Okay. And so when you are transitioning from mediocre investing to high net worth investing, or when you're building a sustainable property portfolio, what you're doing is you're combining these three things together in various mix. And so when you are starting up your journey as a first time investor, or even as a first home buyer, you are predominantly chasing growth and yield. Okay, that's the two main things where you are aiming for short term growth and, of course, long term growth and yield, while maintaining the lifestyle, having a lot of buffers in place, making sure that the foundational stage of your investing is set up right. A lot of people, what they tend to do is, when they are a first time investor, first time buyer, they go for most expensive asset, or they'll go for assets which is going to deliver maximum growth to you. Great, growth is great, but it's going to make you paper rich but not cash rich, and so you will not be able to manage the buffers. A lot of people get confused because they think that they have their salaries to provide the cash flow into the portfolio, without realizing and thinking that, what you're doing is you're exchanging your own worth or your own time with cash, while holding these, growth intense portfolios. And so you should not be making a choice in isolation. What you should be doing is you should be combining the two together, especially in the first sort of 1 to 2 years of property investing. Combine yield and combine growth. Both of them are quite important, and you should not, lose one or go for the other one. Okay. Now, as you transition more into a much more experienced stage of property investing, what I call it more expedition stage of the property investing, you're still chasing growth, you're still chasing yield. But what you can do is you can let go of a portion of the yield in order to, what I call it, is return. So you're talking about introducing properties with renovation potential here. You're talking about a slightly more active investment strategy. You're going for slightly higher risk. But what you're also doing is you are adding more returns or manufactured returns to your portfolio. I'm talking about strategies like conversion homes. I'm talking strategies like converting a 3 bedroom, 1 bathroom to 4 bedroom to a bathroom. I'm talking about simple, small scale development strategies about saving a house at the front, building one at the back, battle X or splitter blocks, etc. And so those are your key entry points into manufacturing your own growth. And these strategies, mind you, work in any environment. It doesn't have to be that the market has to be high or the market has to be low, because what you're doing is you're unlocking the value of the land in majority of these circumstances. Okay. I'll give you a very quick example that, there was a 3 bedroom, 1 bathroom that we were looking for recently in one of the suburbs in Adelaide. And that property was worth $460,000. Okay. And so we acquired that property. We can convert them to a 4 bedroom, 1 bathroom, and a 4 bedroom, 1 bathroom in that same suburb on that same street is selling for $530,000. So it just takes one extra wall. And that one wall would probably cost you $1,500 to $2,000, nothing more than that. But you've created immense amount of manufactured equity without waiting for the market to deliver that to you. Okay. And so those are the strategies that we're talking about when we are basically moving into a much more experienced stage. Now, when you're transitioning into a high net worth space and you're transitioning into a much bigger investment objective, the sustainable property portfolio basically escalates into you chasing returns on equity, which I call it cash on cash returns. And so here you're talking about, full scale developments. You're talking about, much more complex strategies. You're talking about, JV partnerships, sophisticated investing. You're talking about full scale development sites. You're talking about roaming houses, NDIS, anything which is out there. You can basically start combining some of these things here as well. And you can even talk about, commercial properties, start adding some of those into the mix. And so the idea is that you have shifted your mindset from a mediocre investor who was chasing growth and chasing yield to an investor who's thinking about, well, every dollar that I'm going to spend today, am I going to make a return coming back to me? And so minimum return should be, more than 15% or more than 20% every year. Okay. And so that's very, very important. And that's the transition that happens when you are creating a sustainable property portfolio. Okay. And so what you want your portfolio to do is you want your portfolio to be very fluid and agile, such that it can absorb any shocks depending on where you are in your life cycle. Okay. And you don't want the portfolio to be there to just suck the blood out of you. Okay. It's very, very important. Going to the next slide, this is a very important question that a lot of people usually ask. And so The first question that people ask me is, what how do I know which property to acquire in my portfolio right now? So where am I in the various stages of property investing or property investment life cycle? And how do I know which property to acquire for right now? And so I usually divide these into 4 different scenarios. Okay. And so you would find yourself fitting into one of these scenarios pretty easily. And so these scenarios are basically the amount of deposit that you have available to yourself and the amount of salary that you're on at this stage. And now this scenario predominantly applies to people who are on PAYG income, because this scenario is not so much for people who are running their own businesses or have their own businesses. Of course, there are different scenarios that we can talk about in a different life, but this one is more in relation to the salaries that you're generating through your PAYG income. And what you're doing is you're using sustainable property portfolio to put your property portfolio on steroids. Okay, and so the 4 scenarios are basically, you have a high salary, so you are an executive in a company and you're working really, really high salary, and you also have a high deposit. There are also people who have really high salary, but you have a really low deposit because you're not great at saving, for example. Okay, and so you are changing that mindset on, being better at saving, being more disciplined at saving. You could be, the third scenario could be, you could be one of those people who are on low salaries, but you have a high deposit because, you have inheritance coming through, or you made some money, and you were really disciplined in creating that deposit for yourself. And the fourth scenario is where I find a lot of people is that you are low income earner, but you also have a low deposit. A lot of first home buyers basically fall into that space as well. And so we'll talk about some of those strategies as to what do we do in these circumstances. Okay, and so let's look at scenario number 1. We are talking about scenario number 1, where we are talking about you having a higher cash flow as higher salary coming through, and you have a higher deposit coming in place as well. Okay, and so what can you do with your property portfolio right now in order to jump into the mix and set yourself up in such a way that you're ready to basically bounce and take the world and put the property portfolio on steroids. I keep using the word steroids. And so in these circumstances, when you have high cash flow, high deposit, you can typically go for 2 properties quite easily. You can aim one property at a much higher cash flow, at a higher growth, and you can aim for a second property which may be at a lower cash flow but a higher growth. Now, again, the cash flow requirements for both of them is quite subjective and quite relative. I'm not saying go for a negatively geared property, but I'm saying that you can aim for a property with a lot of multiple exit strategy properties. And some of these strategies could be that you're aiming for a bigger land size, for example, or you're trying to do something with that property. Okay, and so in these circumstances, between the 2 properties, your property portfolio would be sustainable enough, and it would be and you could basically push the rent higher by picking one of those multiple exit strategies, by pushing the rent higher yield on the second property, for example, or pushing more growth onto the second property. And that's one of the key things that I see a lot of investors, astute investors, do, where they have a lot of income coming through and they have good deposits. And so I always say to people, don't just go out there and buy the most expensive property. Be more strategic about some of these things, right? Scenario number 2, where you have low cash flow, and so you are on a low income bracket, but you have a higher deposit. And so you have a higher deposit because you might have got, say, generational wealth, or you might have access to money that you've received from your parents, for example. And so how do you make sure that you're using that deposit to your advantage while having a lower cash flow? Now, in these scenarios, what you want to do is you want to not block your serviceability off, by acquiring a really expensive property. And so what you want to ensure is that you don't use all of that deposit. You use as little deposit as possible and buy the first property with decent cash flow, but also growth. Okay. And so don't use the whole deposit. Keep that deposit on the side, because what's going to happen is that the higher cash flow from the first property would potentially give you a bit of a jump in helping you acquire a second property in, say, 6 to 12 months time. Okay, and if you do it right with the tech structure, you should be able to go for the second property in literally 8 to 12 months time. And that's a key strategy for a lot of low income earners, where you have saved a higher deposit. I see this strategy being played out in a lot of families where it's husband and wife, and they've saved well in the past, and so they have a good deposit sitting there, and so they are coming in and starting their investment journey. And so this is one of the key strategies that we play with for a lot of our clients. The third scenario is high cash flow and low deposit scenario. Now, this is the scenario for people who are on, great salary packages. You're young, you're earning good income, maybe from a sales background. And so you're an awesome income, but you don't have a lot of deposit. You haven't done a lot of savings. And so what should you do in these scenarios? Now, in this scenario, of course, there is cash flow coming through. And so you need growth to basically use that as an opportunity to buy the next property, because there is cash flow there, which is not going to limit your serviceability. And so you can't deviate away from blue chip areas. Your areas should be premium areas, which are going to offer you quick short-term growth, because you're going to use that growth to go back into the market and buy something there quickly. Okay. Now, you can use LMI to your advantage in these circumstances where you have a low growth, and LMI would help you, with better asset selection. It would help you, entering into the market with a lower deposit, etc. With a lot of these things, and it's okay to pay a bit of LMI because, one, it's tax deductible. It gives you the power to enter into the market quickly. Number three, it's a better asset selection. So I keep repeating myself, but it's a better asset selection. It gives you quicker entry to the market. It's tax deductible. It helps you with the serviceability, it pushes your serviceability up, etc. All of that. So don't be shy of using LMI in these circumstances. But the important thing for your case is that you aim for a property that is going to deliver you quick growth, so that you can use that growth to your advantage to build and buy a second property. Now, a lot of properties where you can do the conversions definitely come into this space, where you're buying a property in, say, Metro Perth, really close to CBD, in a really, really nice pocket, in an owner-occupier pocket. And so you buy a 4-bedroom, 2-bathroom at a decent yield, and you can convert that house into a 3-bedroom, 1-bathroom, and a 1-bedroom individual isolated unit. And so you can rent them out separately once you have the growth, and you can play with that and build your equity faster. And so it's important to understand some of these scenarios too. Okay. The fourth scenario, which is you hear a lot, is you have low cash flow and you have low deposit, or you have low salary and you have low deposit. When I say low cash flow, it might be that you have low serviceability, for example, okay, and you have a really, really small deposit. Now, in these circumstances, what you're talking about is you're aiming for a property which is going to deliver a significantly higher cash flow, but you're also looking for properties that is going to deliver um, growth in the short and the medium term. Okay, so the growth does not disappear, but the cash flow becomes a lot more important. Also, you need to think about that. How do you push this cash flow further up, and how do you move this yield further up? And so you can achieve a cash flow property yielding 6% quite easily, but how do you take this yield from 6% to 8%? Because that is what you need in these circumstances. These are the properties where the chances of you making a mistake is massive, because you are going for cheap properties. And so it's important that you do your due diligence quite religiously. You are looking at the data at a quite granular level, making sure that you're not making a mistake and getting yourself, stuck into something that shouldn't be bought in the first place. Okay. So those are the 4 scenarios. Now we are going to talk about original question in relation to how do you fix property portfolio mistakes. And so how do you do them, and what is the key thing that you need to consider when you're fixing some of these portfolio mistakes? Now, for those who need this portfolio fixer, please do drop it in the comments saying fixer, and the team would reach out and provide this property portfolio fixer to you in an email. It is quite important. And so when you talk about the property portfolio fixer, it's a series of questions that I ask, not just to myself, but also to the clients, to understand how do you go about delivering or remediating a portfolio. Okay. And when you think about portfolio mistakes, what you're doing is you're looking at each and every property, and this is a true portfolio assessment. You're looking at each and every property, and you're asking a series of questions about this property, whether this property is delivering what it's supposed to do. Okay. And so the first thing that is where you're going to start off is what is the expectations from this property for you? Okay. So is the expectation such that it's going to deliver any significant growth to you? Okay. And so where does this property goes in the next 6 to 12 months based on the demand supply analysis. So you have to always start there to understand what is the suburb delivering you, what is this property type delivering you. Okay. And so let's cover the no's first, and then we'll talk about the yes. Okay. So if the answer is that no, there is no growth coming through this suburb, it was the wrong suburb selection, it was the wrong property selection, you need to understand that, is there any other exit strategy that you can use with this property? For example, renovation, uplift, change in configuration. Could it be land bank value? Could it be full scale, small scale development? Could it be any of those that would help you take a cleaner exit by manufacturing your own equity with this property, with this particular property? If the answer is no, the question then becomes, can you sell this property right now while breaking even? Okay. And if the answer is yes, in these circumstances, cut the losses, remediate, move back, use this serviceability to buy something which is investment grade, so that you can track and monitor and catch the growth, catch the renovation uplift, catch the returns, catch the yield from a better value asset. If the answer is no, I always say to people to watch for the next 2 to 3 months before you do this reassessment and make the call of cutting the losses. Okay. A lot of the times where you would be a bit stuck is you wouldn't be able to cut your losses because you can't have a clean break even, or you're making a loss in some of these circumstances. And so I'll share a story of a friend of mine who owned an apartment in Darwin that is costing this person close to about $12,000 to $15,000 every year to hold. And so every time he has done this analysis, he has come to the conclusion that, oh, I can't sell this because I'm not breaking even. But the longer you wait, the more money it's going to cost you. And so there are times where you have to bite the bullet. You have to take the poison and basically move in that direction, because it's important to cut the losses and move, because the property is not performing and it's never going to perform. Okay. Now, if the scenario or the question becomes yes, okay, and you can see that there is growth coming through some of these properties, the important thing is, can you make the yield work? And so can you increase the yield of the property portfolio such that it becomes sustainable, it's not costing you your lifestyle? Can you convert it into co-living space? Can you convert it into a granny flat, etc.? Anything. If the answer is yes, use that money from the growth or the equity from your other properties and spend that money to basically create that sustainability for yourself and hold that property for the next 6 to 12 months. If the answer to this question is no, basically follow the same cycle. Okay. Now, the important thing to understand is that, the whole idea of fixing the property portfolio is that if you can hold the property successfully, if you can create the cash flow from the property successfully while knowing that there would be future benefit from this property, then do it. If there is no future growth, there is no subdivision potential, there is no renovation potential, there is no return in the future, holding a dud property would always be a dud property. And so I see a lot of people holding on to apartments where they are saying, oh, it's not costing me any money to hold. Well, technically it is, because although the property, the apartment that you might have owned for, say, or you've bought it for, say, $500,000 and it's rented for $600,000, it's breaking even. Because there is no growth coming in, understand that the yield is what brings in the income, but the growth is what gets you out of the rat race. And so it's important that you don't objectify yourself into understanding that, oh, because it's not costing me any money, I'll just keep holding it. Okay. The opportunity cost of you using that serviceability on something that's not going to grow is massive. You can still buy a $500,000 property that would convert to $1 million property in, say, 5, 6, 8 years time frame. And so if you are not achieving that from a property that's not even costing you money to hold, you shouldn't be doing that. Okay. And so that's the most important point that I wanted to make here. So reach out if you want to get hands on this. I'm happy to share this with anyone. So drop in the comments below, write property portfolio fixer, or just fixer in the comments below, and you would get access to some of these things. I'm going to open the floor to questions. If you have any questions, what sort of portfolio mistakes that you are trying to fix, drop in the comments below and share some of those insights with me. I'm just going to run it past and see as to what comments are there. See what Romana is asking. So Romana is asking, hey Moss, I have a question regarding strategy for Muslim clients who don't believe in taking another loan to pay off home loans and to grow wealth by taking loans. paying interest. However, their interest to own real estate is still high. So what would you suggest in that circumstance? High income earners with comfortable deposits. Look, I mean, that's a lifestyle choice, right? If you are not going to use the debt to your advantage, then of course it's a lifestyle choice. You can't do much with clients where they are focused on not getting the loans. Now be mindful that there are loans available for Muslim clients as well. It's still a loan. You can still use those loans in the context of religion. And so they don't call it interest loans, they're called rentable loans. So you're paying rent instead of interest. And so there is opportunities and products available even for people who are not pro getting loans. And so you can explore those opportunities. Of course, the interest rates in some of these scenarios are quite significantly higher. And so what you need to do is you need to look at what's the best alternative available and then do the comparative analysis for them, and then make some of those suggestions there. Happy to take this offline as well, Romana, and have a bit of a brainstorming session in relation to this. Mark Roberts is asking, what structures are you looking at purchasing these in? When you talk about trust structures, I've done an amazing podcast in relation to trust structures. So what I would suggest you guys do is log in to or join into a podcast and listen to the trust podcast. I'm not going to reveal all the surprises that are there in the trusts and how do you structure some of these things. There are two key things. I'm just going to say this. There are two key things when you're talking about trust structures. You're talking about discretionary trusts and you're talking about unit trusts. Okay. And so you can combine the two together when you're talking about development deals, and you can keep them separate when you're talking about building the profiles. Understand this, that you can have a lot of discretionary trusts or family trusts set up in order to manage your land tax side of things, in order to manage your serviceability quite well. And so wait for that podcast to come out. I think it's episode number 13, which will be coming out in the next 2 weeks. And so watching for that. We've talked a lot about trust in a lot more detail, and I'm sure you would get a lot of value out of this. Favorite question, 2023 rate predictions. My personal feel, and I've shared some of these in the post as well, that I can see that the markets are correcting in Sydney and Melbourne, but they are not at that point where they're still slightly overvalued. Okay, so I'm not claiming that the doors are open for people to go out there and buy in Sydney and Melbourne. Probably the best time to come back in Sydney and Melbourne would be somewhere around April. Okay, that's what I think. Interest rate predictions, I think my personal opinion is there would be 2 to 3 more interest rate rises coming through. If you look at the inflationary data that is coming in on a monthly basis from Westpac, you can see that inflation, although coming in quite strong, it's there. It's not tapered off. It's not dropping off. And so you would see RBA making some news around February, March, April for more rate rises. My long-term prediction for interest rate is that you would see interest rates settling somewhere around 4%, 4.5%. That's what I feel, that where the equilibrium sits for interest rates. What's also important to understand is that a lot of investors, astute investors, would realize post April, May, June, that the market has already hit the bottom. And so there's a lot of people who are sitting on a lot of cash, and they'll try to come back into the market to acquire some of these properties. And so people who are sitting on their last available serviceability as the interest rate rises come through, you would realize that your serviceability basically caps out, and so you lose the entry point of coming back into the market. Now RBA does this all the time. What they do is, and this is typical of RBA, is that they would share a news to get a response or reaction from the market. And so you remember RBA's governor coming out of the market and saying, you're not going to raise interest rate rises till 2024. And then you saw a massive frenzy of people coming into the market, basically, buying, doing a lot of buying. In relation to the drop of interest rates, the RBA is not going to really do any drops, not till the fourth quarter anyway. My expectation is you would not see any drops or any news of the drops till the second half of the year. Okay. And so even with the news of the drops, they'll try to get the reactions coming from the people. And so you'll start seeing media talking about, interest rates are plateauing, interest rates are coming off, they're going to deliver an interest rate cut in probably the second half of this year, which is post June, July. Okay, and so you would see a lot of investor activity coming back into the market, whereas interest rate hasn't really dropped off yet, right? And so a lot of people who are waiting for the market to bottom out, or who are saying, oh, I still have the serviceability, will be kept out of the market based on the next 2 or 3 rises that is going to happen. So it's important to understand that you should not always wait for the bottom to happen. Get in just before the bottom is great as well, because you would be on the upside of it. You can see Brisbane quite significantly adjusting. You are seeing suburbs where the adjustment has happened between 100 150,000. It's a perfect opportunity to go back in and buy in some of these areas. You're seeing rental pressures actually coming off, and so I know that media is talking about this massive queue in Sydney and the rental pressures, etc. If you see the house dwellings, the number of dwellings that are being created this year is slightly higher than last year. And so it's important to understand that, especially in Adelaide right now, you can see a lot of rental pressures, or the fire rentals is slightly coming off. And so it would be interesting to see our analysis that would come out in the next sort of 1 to 2 months about what the market predictions look like. I think that's a myth. I totally think that that's a myth. I think that a lot of people who have lower interest rates have already seen interest rates coming off from their fixed to the variable rate. I think what the media is portraying is that everyone who's out there in the market is basically struggling with the lower interest rate versus higher interest rate. Now, understand this, that when you're talking about interest rate rises, and I've seen this happening in 2005-6 when interest rates were at peak, people naturally don't come out and start selling their properties in the first instance. Okay, it takes probably 6 to 8 months to 12 months worth of lag for some of these factors to basically play in. And so even if this is true, which I don't believe it is, even if this is, because you should look at the data, I'm happy to share some of this data as to how many people are coming in off the fixed interest rates. But even if this is true, understand that when people are coming from the fixed loans to the variable loans, it's not that as soon as they hit the variable loans, they will be out there on the market selling their property. That's a myth. That's a lot of things that people think is going to happen. That's not exactly how it happens. Think from an owner occupier perspective. Think from an investor's perspective. An asset is something that they try to hold on to for as long as possible. So the first thing that happens is, they'll try to cut their discretionary spending. Number one, to hold on to their assets. Number two, they'll basically go out and speak to the banks to see if they can get some preferential rates, or some deferred payments, or recast their interest-only repayments, or interest-only payments. Okay, there'll be rate negotiations. And so a lot of people try to hold on to this. And so even if that doesn't happen, understand that in the last case of the scenario, people are still sitting on a lot of cash, and so they'll use the equity to ride this wave. And so the real impacts on some of these things, if this scenario is true, you would see somewhere in 2024 where people are actually coming off. They've depleted all their offset money or their equity growth, and the rates are still high. And so the expectation is that the rates would plateau off, and the inflationary pressures that were there pre-COVID times would basically come back and would create that equilibrium in the market. That's it for today. Thank you very much for tuning in. Thank you for sharing a lot of questions. I really enjoyed it. Again, if you are looking for any specific feedback, any specific comments, please feel free to drop it into the comments below. If you're looking for the portfolio fixer, drop the word fixer into the comment below. In any platform that you're using, be it Facebook, LinkedIn, YouTube, and someone from my team would come in and help you out. Thank you for joining in today. Keep smiling, be kind, and keep investing. This is Moss checking out. Thank you very much.